Hello and welcome to my YouTube channel, the Corcoran Codex. My name is Clive Corcoran, and in these videos and screencasts we will be analysing critical ideas from the world of finance. In this screencast I want to examine duration risk, and I will begin the discussion by looking at losses that are currently being incurred by leading central banks as a result of their policy of quantitative tightening, or QT. So as you can see on the slide, I have in fact pointed out here three of the world's leading central banks: the US Federal Reserve, the ECB, and the Bank of England. And the point that I would begin with is that when one of these large central banks buy their own government bonds, they really don't face any credit risk, because the bonds that they're buying, being issued by governments in these countries, would be deemed to be default risk free. However, there are market risks associated with selling these government bonds before they come to their maturity. So as a result of quantitative tightening, which essentially is a reversal of the QE programs that all of those banks and others conducted, really going back to just after the financial crisis of 2008, the QE programs led to a massive accumulation of government bonds being held on the balance sheets of those central banks. Now, if these central banks start selling some of the bonds that they were acquiring during the QE phase, and these bonds have not reached maturity, but they're being sold with a view to contracting the balance sheets of these central banks. This is the QT program. So if they sell the bonds before they mature, they can face and are facing significant market losses. To give just one example, the Bank of England has already incurred more than £100 billion in losses resulting from its QT program, and this is expected to go even higher. Now, the reason behind this, which is perhaps one of the less well understood features of bonds, fixed income instruments, stems from what is known as duration risk. And I want to illustrate that in this screencast, and in a subsequent screencast I want to actually go through the logic, the mechanics involved behind this issue to do with duration risk. The problem I've mentioned is not only confined to central banks, but also has risen with regard to commercial banks. Perhaps the most notable example being the collapse of Silicon Valley Bank in California back in March of 2023. One could argue, as I would, that this is actually a case study in how that bank totally mismanaged its interest rate and duration risk. The bank had a very large portfolio of long duration US Treasury bonds, many of which had been purchased when interest rates were extraordinarily low around the time of the onset of COVID, 2020, 21, and so on. Silicon Valley Bank then faced an abrupt withdrawal of deposits, which in a sense is another story which I don't intend to cover in this screencast. And in its attempts to try to cover the $40–50 billion worth of depositor withdrawals, they started selling some of the bonds that I've just been mentioning. And then they started to crystallize serious losses. The actual exodus of deposits from Silicon Valley caused the bank to basically become insolvent, and the FDIC then shut it down. As interest rates on a global basis began increasing in 2022, as a result of the concerns about inflation, of course, the mark-to-market value on the securities that SVB was holding began to drop rather dramatically. And that can actually be illustrated on the next slide. So this is a chart basically taken from the Wall Street Journal during the latter part of February 2025. And let me explain what can be seen on the screen. So this highlighted bond here is actually a 10-year US Treasury note auctioned by the US Treasury in May of 2020. So it matures in May of 2030. So has basically about another 5 years to run from when this is being recorded. Now, this bond was issued with an extraordinarily low coupon, 0.5%, perhaps one of the lowest coupons ever put on a US 10-year note. Now, when this was captured, the pricing in the market was such that the bond here needed to be priced to yield 4.36%. Now, why would that be the case? Well, this bond needs to be competitive with other bonds that, say, the US Treasury is currently issuing, and those bonds might well have a 4.5% coupon on them. So in order for this bond to be competitive with such bonds, the price to yield means that the price that this bond would have achieved if it had been sold on this particular day would be close to $82, way below the par value on the bond, the $100 that the bond would actually redeem at back here in May of 2030. Now, it's useful to see in the bond that's below this one here, this is also maturing on the same day in 2030. This is actually a 30-year bond that the Treasury auctioned back in 2000. So this bond has already run for 25 years, but still has another 5 years remaining in its lifetime. As you can see, rates were much higher in this period, and this bond, when it was auctioned, had a 6.25% coupon. Now, as you can see, this bond was marked to market on this particular day at $108 or thereabouts. So this is trading at a significant premium to the par value of $100 because this bond is far more attractive than this one. You get a higher coupon than actually the required to be competitive with bonds being issued with a 4.5% coupon. That thereby justifies a premium above the par value, and in this case, as you can see, it's $108 or thereabouts. To continue illustrating the issue of duration risk, let me point to another bond here. This is an Austrian government bond that the Austrian government, a member of the euro area of course, this bond was auctioned by the Austrian government in 2020, and when the bond was issued, the coupon on it was below 1%, 85 basis points. Now, during the period since this bond was auctioned, the price has moved up and down in line with changing policy rates on the part of the ECB. Soon after the bond was issued, the deposit rates and market rates based on those moved into further negative territory. Policy rate at the time was 50 basis points negative, and at that point the mark to market on this bond was 139 euros, significantly above its par value. But over the next year or two, the ECB's policy rate went from negative 50 basis points to 1.4%. And at that point, in October 23, the mark to market on this bond was 33 euros. It can be seen over here. Now, when this is being recorded in February 25, when the ECB policy rate is now at 2.75%, the price on this bond had improved to around 48 euros, as can be seen. It's important to point out that if one held this bond all the way through to maturity in 2120, you would then redeem the bond at its par value of 100 euros. But, and I'm being somewhat ironic here, it remains to be seen what the purchasing power of 100 euros would be in just under 100 years' time. And one further illustration that we can look at is to do with a bond, a gilt, issued by the UK government. This is a 40-year gilt, which was auctioned in October 2021, so doesn't actually mature until 2061. And as can be seen, the bond, when it was auctioned, had a 50 basis point, 0.5% coupon on it. And when this is being recorded, as can be seen, this bond would only have a market value of around £30. So essentially a 70% discount from its par value of £100. And I could make the same point that I made with regard to the Austrian bond. It remains to be seen what in fact the purchasing power of £100 will be in 2061. So thank you very much for watching this screencast. I hope you enjoyed it and found it useful, and I hope that you'll continue to follow some of the material and screencasts that I will be covering with regard to these critical ideas in finance.